So today's topic is the role of accounting, chapter number 9. So this topic is something which many students who are from commerce or accounting stream are very much familiar with. So first we'll see about what is accounting function and the role of accounting, then financial systems and accounting systems. Role in the organization, what accounting has importance in the organization, external reports, internal reports, system requirements, main systems under financial systems. We're going to study all that. So see, role, the accounting function. First of all, function is nothing but something is performed, right? So role in organization, main function, the accounting function is part of broader business system and does not operate in isolation. So it is connected with many other functions, right? It has a connection with many functions, every function has some of the other monetary aspect involved in it or with it. So accounting, wherever the monetary aspect, wherever you see monetary aspects or monetary nature, things happening, accounting has a role to play there. So it handles the financial operations of the organization, but also provides information and advice to other departments. Typically, large organizations structure their accounting functions on the line of finance director. So he is the one who is responsible for the finance function, and the finance director is someone who heads the accounting function. Okay, reports to the chief executive officer and board of directors. Now, treasurer, financial controller, management accountant. So the finance director is one of the directors, like many directors, risk director, finance director. So they have to report to the CEO or the board of directors, whoever is hired to them, okay, in position, or they are subordinate to whom they are subordinate to. Accounts are produced to aid management. Management accountant is responsible for making budgets and costing or cost accounting function. And treasurer, like finance director, under finance director, these people work: the treasurer, the financial controller, the management accountant. These people are responsible for cash flow controls, responsible for routine accounting, responsible for budgets and cost accounting. Accounts are produced to aid management in planning, control and decision making. So see why the accounting is done in the companies, why the accounts are produced or prepared. Accounts are produced to aid or support the management in planning process, control process and decision making process, and to comply with statutory regulations. It's very important for every company to prepare the financial statements, right? The accounting department must be adequate to fulfill these functions. They should have enough staff, enough size, enough people in them to fulfill these functions. An organization's accounting department is affected by nature of its business, what kind of business they are in. So organization's accounting department is of course affected because the function of the accounting department is to take care of all the financial aspects. So like the organization's accounting department is affected by nature of its business transactions and the sort of business it is. Okay, so accounting, an organization's accounting department is very much affected by the nature of the business transactions which happen in the company and what kind of business it is, right? An appropriate accounting department will depend upon size of the organization, type of organization, structure of organization, legal jurisdiction of the organization. So a very appropriate accounting department will depend upon what kind of organization it is, how big it is, what type of company it is, what is the structure of that organization, and where they are operating, in which legal jurisdiction. Accounting department will provide the basis for financial information used internally and externally. Of course, see, it is the accounting department which prepares the journals, ledgers, and all the trial balance and financial statements, and that gives a final answer to the questions of many stakeholders. So that becomes the basis of financial information. used internally and externally. Policies and procedures. See, in any organization, there is a need for order, coordination, and control to ensure efficiency. Of course, things should be in very order. There should be coordination and there should be a proper control so that everything is done very efficiently. To achieve this, management often implements rules and procedures. They have to make this. For example, there will be authorization policies for purchase of non-current assets. Yeah, of course, if someone has to purchase a non-current asset of some size, only some employees in the companies are authorized to do that, not everyone, right? Procedures for choosing new suppliers, procedures for accepting new customers. Policies, see, policy is what they are going to follow. This is my policy and I work accordingly. Procedure is what is nothing but the methodology they apply to do certain tasks. So policies and procedures may be grouped in form of a policy manual. So there will be policies which will be implemented. That means how the work, what work on what basis and how and in what way they are going to do. And procedure is nothing but how they are going to apply the step by step, they are going to put all the steps forward to perform the task which is what they have mentioned in their policy. Now perhaps stored on organization's computer network for easy reference, although a policy manual is to be recommended as a form of control over activities of employees. So see, if the policy manual is made, everyone works accordingly. So there's a control over activities of the employees. They are not going beyond the policy, beyond the points mentioned in the policy manual, right? Care must be taken that strict adherence to rules does not create inflexibility. Many organizations have an internal audit department, we have discussed yesterday one, right, which is designed to alleviate the risk of error and fraud. So which is designed to minimize the risk of error and fraud. Internal auditors are employees of the company, but most internal audit departments aim to retain independence from other departments. They want to work independently, it seems. One of the roles of an internal audit department will be to ensure that staff are complying with company's policies and procedures. Handling clients' money. In some industries, the nature of business means that money is held on behalf of clients. So, like banks are such businesses, fund managers, they make mutual funds, and investors, they like invest their money by taking those funds. And also some financial services, they give lawyers and accountants. They, hold money on behalf of their clients. Now, there must be strict policies over how client money is held. In particular, the money held by clients should be held in separate accounts from those of rest of the business, so that they do not get confused, and should the company itself go bankrupt, then clients' money will be safe. See what happens. There should be a very strict policy over clients' money, which is held by all these banks and mutual fund companies, etc. So money held by clients, whatever the money is held by the clients, their money should be held in separate accounts, should not be clubbed with the business accounts. Like otherwise, what happens? There shouldn't be any kind of confusion, and company if company goes bankrupt, even the client's money should be safe, right? So they should be maintaining them in the separate accounts. Regulations relating to handling clients' money are issued by industry regulators in UK. For example, the financial services industry is regulated by the Financial Conduct Authority, FCA. Businesses must also comply with regulations related to money laundering and are required to ensure clients are not using client accounts for money laundering purposes. Money laundering is described in Chapter 11. Money laundering is nothing but diverting the company's money or money to some other channel, and black money kind of. So when you have black money, you want to black money is nothing but not paying taxes, and those money they want to divert to some safe haven. So we'll study about money laundering in Chapter 11, and you'll be also coming across money laundering in F4, the law subject. The accounting department will be responsible for monitoring clients' money. They will monitor how the money is utilized and in what way the money is utilized. Performance. So there comes the role of the accounting department, which is very important, right? Just a second. Performance. An important area of responsibility for the finance department is performance management and measurement. This involves setting targets for other departments and monitoring their performance against those targets. What is performance management? So finance department has to see how the the performance the company is performing. By setting certain targets, they will see whether the targets are achieved or not, and then the performance of the departments is also monitored. Like budget is one of the example. Budgets are made or prepared by the department, the finance department. Let's say they made a budget of 100,000 for some task, and if the company was able to achieve the target in $80,000, that means the company has saved $20,000. It's a good performance, right? So target, whatever they set, they were able to do within the target. Now financial accounting. Financial accounting is what? Is primarily concerned with providing information to external stakeholders. External stakeholders can be like many parties like investors, lenders, government, customers. These are the external stakeholders. So the financial accounting is prepared for the external stakeholders, and particularly for the shareholders who are the actual owners of the company, because they are the ones who are concerned to know about the company's performance at the end of the year. Financial accounting involves recording transactions in the books of prime entry, of course, like the subsidiary books, cash book, purchase book, sales book, purchase returns book, sales returns book, petty cash book, etc., and journals. Then what they do is they analyze and categorize the transactions by posting them in ledgers, and then they make the trial balance and financial statements at the end of the year. That's the summary. Now, regulatory system. See, it is not only you make rules and regulations and you just you just make the rules and regulations, and your task is accomplished. No, the point here is there should be a regulatory system even which has to ensure that all the rules and regulations are followed. If not followed, then they have the mechanism to penalize. So requirements, most countries have laws. So it's not laws. See, it is not that the legislature is making the laws for the nation. The laws should also be followed. If not followed, the consequences would be uh, like uh, very harsh. So if that is the case, then everyone would be kind of seriously following. So most countries have laws that require companies to keep proper accounting records, file financial statements with the government's company registration body, that is Companies House in UK. In India, we have Registrar of Companies. These financial statements are then available for inspection by members of the public. So first of all, every company should keep proper accounting records, and they should also file the annual returns at the end of the year with the registrar of companies, and so that those can be inspected by members of public, that is shareholders. There may be a requirement to have financial statements audited by an independent accountant. The role of auditors is discussed in Chapter 10. In the UK, an audit is required for all companies above a given size. That means some share capital or they generate some revenue, right? Turnover of some amount, etc. According to criteria related to revenue, value of assets, and number of employees. So it depends upon what size of company it is, and accordingly, audit should be mandatorily performed. Auditing function. There's a activity one, government's company registration body. Why is there a requirement for financial statements to be available for inspection by members of public who might be interested in inspecting the financial statements? So you have to give the answer for this. What can be your answer? Tanya, come on. I'm asking this. Can you answer this question fast? Hello.
Yes, sir. Usually the as it is what do we say?
First read the question very properly and then try to answer. No rush.
Okay, sir. The people who take the taxes, maybe.
Sorry.
The people who take the taxes, like you know,
Who are the one who takes taxes? If you can be very precise.
tax authorities.
Tax authorities.
Yes, sir.
So government's company, so this is the activity, right? So why is there a requirement for financial statements to be available for inspection by members of public? Actually, who are the ones who want to see the financial statements of company? The lenders, right?
Yes,
First.
sir.
Second, the suppliers. So they want to before lending, they want to know the statements. Before giving credit to the customer, these people want to know their financial position. And then employees, they want they want secured employment and good future in a company, so they want to know the financial statements. Profitable company can give them that.
Yes, sir.
And then the tax authorities, that is the government, right? Her Majesty's Revenue and Customs, HMRC in UK. And customers, you can write this 5 points. Okay, next. Regulation of unincorporated entities, that is unregistered or unlisted companies. While most of the regulations have above apply only to companies, other forms of business entity are required to comply with some regulations related to accounting. Example, businesses registered for sales tax are required to keep records of their sales and expenses to support the numbers of their sales tax returns. Of course, because the authorities will ask them if they have any kind of doubts anywhere. So they have to always maintain the sales tax returns. Taxpayers are required to maintain records of their income to support their tax returns, of course, the individuals. And such returns might include profit of unincorporated businesses. Charities may be required to report to charity regulators. Because charities are something people can take undue advantage of, right? So the charity regulators will be asking about charity. Now, next point. Proper accounting records. What do you think is meant by proper accounting records? Can you answer this? So all transactions should be properly recorded, right, in the books of prime entry
Yes,
and
sir.
ledgers, journals, right? And then
Yes, sir.
the transactions should be, like we can say the tax for tax returns purposes also the thing should be maintained, right? And the auditors will be checking the accounts of the company. So in the sense, the books of accounts should be properly maintained, right?
Yes, sir.
And they have to file the annual returns also. So for that reason also they have to maintain proper records, right? Now, Consequence of failing to comply with regulations. If the companies do not follow the regulations, then what? Companies can be fined for failing to keep proper accounting records or for failing to file the financial statements with government's company registration body on time. So if they do not file annual returns, they will be penalized, fined. If companies persistently fail to file accounts on time, they can be stuck off by the company's registration body. Their names will be removed. Inaccurate or late tax returns can lead to audits and investigation by tax authorities, which can lead to fines and tax penalties. Auditors may issue a qualified, that means they are not satisfied with the company's statements. They find lot of serious serious misstatement in the company statements, right? So they find errors or fraud kind of element of doubt they have. So then only they'll give qualified opinion. Unqualified opinion is good. Qualified opinion is bad. Now, PCAOB, Public Oversight Boards, it's in US, but in UK it is FRC. Review financial statements on sample basis to ensure that the accounts comply with relevant regulations. If they do not, the companies may be required to reissue the accounts. That means all the standards should be followed, complied with. Where a company has issued financial statements that are designed to intentionally mislead the users, directors are guilty of fraud, which is a criminal activity. They may therefore face jail or other sanctions. Directors, so frauds are very strictly punished. Fraudsters. Directors or officers of companies may be subject to criminal procedures for failing to adhere to accounting regulations. If a listed company fails to publish financial statements within the required deadline, the company listing in the stock market can be suspended, right? So that means 4 months after financial year end in the UK, they don't submit their statements. They publish their statements in the official website or whatever they disclose to public. They don't disclose to public, then they're like they will be delisted. And suspension will happen, not delisting, suspension. This means that it will no longer be possible to buy or sell the company's shares. Now, regulation by accounting profession. While company law sets out the basic accounting requirements that govern companies, detailed guidance is often provided by the accountancy profession. The accountancy profession is made up of the bodies like ACCA, which oversee the activities of their members. The profession is often independent of the government, although governments do oversee the activities of the professions to ensure that they are acting in the public interest. Yes, see, they may be a separate body, but government will definitely be overlooking their work, right? They will be kind of having an oversight on them. Following regulatory bodies regulate the accounting profession: IASB, IFAC, and National Accounting Standards bodies. So IASB, is very much responsible for preparing IFRS and is a non-profit organization whose members include representatives of accounting bodies and representative users of financial statements. That means the people, public who use the financial statements, they represent these bodies, and also representatives of accounting bodies. IFRS provide detailed guidance on treatment of specific items in the financial statements. For example, IFRS 15 deals with recognition of revenue. IFRS 9 deals with financial instruments. IFRS provide detailed guidance on treatment of specific items in the statements. As I said you right now, IFRS 15 deals with recognition of revenue. I said about IFRS 9. IFRS standards have been adopted in many countries around the world. Adopted, I said, right? And many of them have also converged, like not adopted completely, but accepting, like India. While within EU, listed companies must prepare financial statements in accordance with IFRS. That is mandatory. IFSA global accountancy body. Its membership is made up of 170 accounting bodies throughout the world, including ACCA. So IFSC aims to ensure that accountants throughout the world operate to a consistently high standard. IFSC codes issues a code of ethics and also issues international auditing standards. They give the standards. National accounting standards bodies set accounting standards for use their particular countries. Like in India we have ICEI. So national accounting standard setting bodies are the ones which make the standards for their home country. Stock exchanges, set requirements relating to provision of financial and other information by companies whose securities are listed on their exchanges. So they make sure that all the companies follow the rules and regulations for listing, and listing requirements are fulfilled. In the US Stock Exchange Commission oversees the reporting requirements of all companies listed in stock market. That means it's like SEBI regulator. Public oversight boards monitor and review the activities of accounting profession. In some countries, they are government bodies, while in others, they are private sector. Examples include Financial Reporting Review Panel in UK, which reviews published financial statements on sample basis to ensure that they are compliant with relevant accounting standards and guidance. So private sector also does this. Private sector firms also do this task of reviewing the statements and looking and giving opinions and reports whether the companies are following the or complying with the accounting standards or not. Public PCAOB is in US, which oversees the audit of listed companies. It was set up under the Sarbanes-Oxley Act in wake of Enron scandal, which I explained yesterday, right? So I would conclude the class today. Have some task. Uh, uh, like actually I have to go out and came very late as well. So I'll see how many units are there in this. Just a second.
4, sir.
4 topics, right? 4 topics. Actually, the thing is, I will take more 5 minutes, no problem. At least 30 minutes classes to be taken.
There are 5, sir, actually.
5, right? So,
Yes,
okay,
sir.
we will take this one, no problem. Financial information, external reports. So what is prepared under the external reports? SOPL, which has all the details about the income and expenses of the company. Then SOFP, which has all the details about the assets and liabilities of the company, called balance sheet. And SOCF, statement of cash flows, which shows the inflow and outflow, how it is happening in the company in all different activities like operating, investing, and financing. Companies might also prepare other financial reports such as sustainability reports or integrated reports. So this is something which you don't have in your syllabus, but financial as well as non-financial aspects are also considered in these 2 kind of reports. Statement of profit or loss, is prepared at the end of the year, and the stakeholders will come to know about the company's actual performance by seeing the statements, whether they have earned profits or losses. Revenues and expenses are part of this. Okay. Statement of financial position shows the actual position of the company. Like when the company started its operations, the first year of the operation, the assets what they had were of $1 million. Now after 10 years, the assets are $10 million. So we understand the position of company right now. It's 10 times more than what uh, it is today when we invested, right? And we came to know about the company's liquidity, solvency, position with the help of the balance sheet. And from statement of profit or loss, we come to know about the profitability position of the company. And statement of cash flow shows the cash balance at the end of the year after adjusting, after taking into consideration the cash inflows and outflows in all the 3 activities like operating, investing, and financing. Here cash basis is followed, not the accrual basis, but in preparation of financial statements like SOPL and SOFP, we follow accrual concept. And I think you may be knowing what is accrual concept, right? Now there is a activity. Please answer this. Hello, can you answer this question, Tanya?
I'm looking through it.
Okay. How will shareholders use information provided in the 3 financial statements? I can give you as a homework. Can you just send me that answer?
Okay, sir.
And my one thing I would like to tell you is, I don't want written answers. I want the answers to be typed in Word.
Okay, sir.
Why I'm giving this task? For your future, because in future all the papers are computer based, right?
Yes, sir. Yes, sir.
So from now you have to develop your skills and speed. So purposefully I'm doing that. Now, sustainability and integrated reports, as I said you already, financial statements have limitations. They provide only financial information, but what about the non-financial information, whereby also some of the parties may be interested? So they provide only financial information. So ignore the other impacts that an organization has on society. They provide only historic information. Users of accountants are interested in future prospects of a business. Many businesses now provide sustainability reports. So that will ensure the users to understand whether company is going to sustain for a long period of time or not. So integrated reporting is a new approach to corporate reporting, which aims to provide a holistic view, overall view of performance of an organization by looking not only at the financial performance, but on the impact the business has on nature and society as a whole. Also, what they are doing good for the society. An integrated report aims to be concise, and there has been much criticism recently about the amount of detail required in the financial statements. Integrated. So this is what the companies do not want, the managements do not want to disclose. So integrated reporting standards are issued by the International Integrated Reporting Council. Adoption of integrated reporting is mandatory in some countries like South Africa, but voluntary in others. It's upon you. If you follow, that will create a goodwill, right? Management accounting, they are the ones who help. They are the ones who are called management's accountants, and they help the management in decision making. They are involved in planning, controlling, and decision making processes. They make cost sheets and prepare, ascertain the cost of the product, because they're also called as cost accountants as well. And they prepare the budgets and set targets, and they see whether whatever the budgets they have made, the company is able to perform the task within that budget, or it's crossing the budget. If it's crossing the budget, it's unfavorable performance, and if it's within the budget, it's favorable, right? So that is what they disclose in the variance reports. So variance reports are nothing but standards are compared with actual results. That means standards are what you have set the under the budgets, what you have estimated, and actually is what is happening actually. So if the standard, if it is like 1 lakh is the budget you have made, and actually you have spent 1.2 lakhs, it's bad, right? Adverse or unfavorable. If it is like in 80k you have done, it is favorable. That's what. So this is, you will learn about this in MA subject, right? So financial systems will continue in the next class, Tanya. Okay.
Okay, sir.
Okay, Tanya. Read till here, and in next class we will try to wind up the chapter, right? Thank you.
Okay, sir.
Yeah, thank you.